You're sitting on the train, half watching the window, half watching some stranger on your feed brag that their portfolio is up 30% this year, and a quiet voice in your head goes, "Okay, I really need to start doing this." So you open the brokerage app you downloaded 6 months ago. You see PE ratio, market cap, dividend yield, bull, bear, yield curve, and your brain just taps out. You close the app. You tell yourself you'll figure it out this weekend. Spoiler: this weekend never shows up. Here is the thing: that weekend doesn't show up because the stock market, the way it is packaged for you, was basically engineered to keep regular people standing outside the door, nose pressed against the glass that stops today. My name is Tom, and I spend an unreasonable amount of my life obsessing over one weird question. Why is the single skill that decides whether you retire at 60 or stack boxes at 75 the one thing nobody bothered to teach you in school? 12 years of education and not one class on the actual machine your paycheck has to survive inside. So if you're the person who knows deep down that you should be investing, but every time you try to research a stock, you feel like you walked into a lecture in a language you don't speak, hit subscribe and smash that like button, because this channel exists for exactly you. Now, let's talk about why this actually matters with a number, not a vibe. The National Financial Educators Council ran the math and found the average American loses around $1,500 a year purely from not understanding their own money. $1,500 every year. Run that out 12 years, and you're at $18,000. That is a decent used car. That is a year of rent in most of this country. That is a Roth IRA contribution stretched across 3 years, and you're not losing it to some villain in a suit. You're leaving it on the table because nobody, literally nobody, sat you down and said, "Hey, here is what a stock actually is. Here is what nobody tells you." The market isn't confusing because investing is some galaxy brain skill. It is confusing because the financial industry quietly benefits when you feel stupid. Confused people pay fees. Confused people freeze. Confused people hand their money to someone in a nice office who charges 1% a year to do what you could do in an afternoon. So let's rip the curtain down. Right now, in plain English, a stock is ownership. That is it. Buy one share of Apple. You own a microscopic, almost embarrassingly small slice of Apple. The factories, the iPhones in production, the cash sitting in their accounts, the future profits. You have a real legal claim on a sliver of all of it, and that ownership pays you in 2 ways. 1. Capital appreciation, which is a fancy phrase for the price went up. Buy at 100, sell at 150. You made $50. Simple. 2. Dividends, which are cash payments companies send their shareholders straight out of profits. Some pay them, some don't. We'll get into why that distinction matters more than people think. But here is the deeper question, the one that flips your entire relationship with the market. When you own stock, you are not gambling on a flashing ticker. You are betting on a business. You're standing there saying, "I think this company will be worth more, do more, sell more, earn more 3 years from now than it does today." That mental switch from ticker to business is literally the line between people who quietly build wealth over decades and people who blow up their savings chasing a screenshot they saw on Reddit. So tell me in the comments, before you click off, what is the one money word, PE, dividend, market cap, anything, that has been quietly intimidating you out of investing? Drop it below. I read every single one, and the words you're afraid of are exactly what we're tearing apart next. You're scrolling your brokerage app at midnight, and you see two tickers side by side. Apple, some random small cap tech startup you've never heard of. Same green ticker color, same buy button, same little chart. Your brain treats them like the same kind of bet. That is the first mistake that stops today. Here is the thing nobody tells beginners. A stock isn't just a stock. A small cap tech startup and Apple are completely different animals, living in completely different cages. And pretending otherwise is how regular people quietly bleed money for a decade. Now, let's talk about where these things actually trade, because this part confuses people more than it should. In the United States, the two giants are the New York Stock Exchange and the NASDAQ. Think of them as massive marketplaces where buyers and sellers meet up to swap shares. The NYSE is the older, more old-school one, with a physical floor and actual human market makers walking around. The NASDAQ is fully electronic, all servers, no shouting. But honestly, for you sitting at home, it does not really matter which exchange a stock lives on. What actually matters is one word: liquidity. Liquidity means there are enough buyers and sellers in the room that when you want out, you can actually get out. Picture this: you own a beautiful house in a town where, literally, nobody is buying houses. On paper, you're rich. In your bank account, you're stuck. That is an illiquid asset. Liquid markets solve that problem. You click sell. Somebody's there, done. Okay. But how does a stock price actually move? Here is where it gets interesting. Same rule as everything else on earth. Supply and demand. More buyers than sellers, the price climbs. More sellers than buyers, the price drops. Simple. But here is the deeper question. What pushes people to buy or sell in the first place? Sometimes it is pure logic. A company posts better than expected earnings. The math improves, money flows in, and sometimes a celebrity fires off a tweet at 2 a.m. and a stock jumps 20%. For no fundamental reason at all. Pure crowd psychology, dressed up in a chart. This is exactly why you need to know the difference between trading and investing, because they are not the same sport. Trading is short-term, days, weeks, maybe a few months. You're basically trying to outguess human emotion and market timing. Investing is long-term. You're buying a slice of a real business and betting it'll be worth more in 5, 10, 20 years. Here is a stat that should genuinely make you sit up. According to Dalbar's research, the average equity investor earned 5.5% per year over the 20 years ending in 2019, while the S&P 500 itself returned 7.2%. Read that again. The market handed people 7.2%, and the average human walked away with 5.5%. That missing gap is not bad luck. That gap is panic selling during dips, chasing hot tickers at the top, overtrading, flinching at exactly the wrong moment, behavioral mistakes, paid for in real dollars out of your real future. Now, this brings us to valuation, which is where most beginners completely glaze over. Stick with me. The PPE ratio, price to earnings, is the headline number everyone quotes. It tells you how many dollars you're paying for $1 of the company's annual profit. Stock trades at $50. Company earns $2.50 per S-hair a year. P/E is 20. Translation: you are handing over 20 bucks today for every $1 of yearly earnings. Here is the trap. Beginners glance at a low P/E and think cheap. Load up. They glance at a high PPA and think overpriced. Stay away. Way too simple. A low P/E can mean the stock is genuinely undervalued, or it can mean the market thinks the company's earnings are about to fall off a cliff. A high PPE can mean overhyped, or it can mean smart money believes earnings are about to explode upward. Context is everything. Tech companies often carry high P/Es because people are paying today for massive growth tomorrow. Utility companies often carry low P/Es because their earnings are steady, predictable, boring, in a good way. Neither is automatically a bargain. Neither is automatically a trap. Quick example: Company X P/E of 10, Company Y P/E of 40. Your gut screams, buy X. It is cheaper. But what if X is stuck in a dying industry? The earnings shrinking 10% a year, while Y is riding a booming sector with earnings growing 50% a year. Suddenly, that scary 40 PPI looks reasonable because you're not paying for today. You're paying for what the business literally becomes. Then there is EP's earnings per share. Exactly what it sounds like. Total profit divided by total shares. Company nets $10 million, has 5 million shares out. EPS is $2. Companies drop these numbers every quarter and every year, and Wall Street obsesses over one tiny thing. Did they beat the expectation, or did they miss it? And here is what is wild. A company can post objectively great earnings and still watch its stock drop the next morning simply because those great earnings were not quite as great as the room had already priced in. So here is my question for you, and drop it in the comments. Look at the last stock you bought or almost bought. Were you actually investing in that business for the next decade? Or were you trading the vibe? Be honest. I read every reply. You see a stock paying a 4% dividend. You own 100 shares, and your brain instantly does the math. Free money every quarter. Stop right there. That is not how this works, and the fact that nobody warned you is exactly why most beginners give back their gains within a year. Here is the thing about dividends. A dividend is just a cash payment a company sends to shareholders, usually every 3 months. Own 100 shares of a stock, paying $1 a year, and sure, $100 lands in your account. Feels like a gift. It isn't. On the ex-dividend date, the share price drops by exactly the amount of that dividend. A $50 stock paying a $1 dividend opens at 49 the next morning. You didn't get free money. You got your own money handed back to you in a different envelope. So, why do dividends matter at all? Because they force a company to actually return cash to you instead of hoarding it in a vault or torching it on some vanity acquisition the CEO read about on a flight. Dividend payers tend to be older, steadier, more boring companies. That is a feature, not a bug. But here is what nobody tells you. The yield trap eats beginners alive. Dividend yield is just the annual dividend. divided by the share price. A stock paying $4 a year at $100 shows a 4% yield. Clean. Now picture that same stock crashing to 50, still paying $4 on paper. The yield screen now flashes 8%, and the new investor scrolling at midnight thinks, jackpot. Actually, that is a warning siren. The yield is mechanically high because the price is collapsing, and the company is probably weeks away from slashing the dividend anyway. You're not buying income, you're catching a falling knife with a coupon attached. Now, let's talk about buybacks, because most people investing their first paycheck have literally never heard the word. A buyback is when a company uses its own cash to repurchase its shares on the open market and retire them permanently. Fewer shares left in circulation, bigger ownership slice for everyone still holding. Picture this. A company has 10 million shares, trading at $10 each. Market cap, 100 million. The company buys back 1 million shares and shreds them. Now, only 9 million shares exist. If the business is still worth that same 100 million, each remaining share is suddenly worth $11.11. No cash hit your account. You just got richer anyway, quietly, mechanically. This is where it gets ugly. One camp says buybacks are elegant, tax-efficient shareholder returns. The other camp says executives use buybacks to juice the stock price, hit their bonus targets, and skip giving raises to the people who actually run the warehouse. Both sides are right. What you need to walk away with is simple. Buybacks are a return of capital. Dividends are a return of capital. Same family, different costume. This brings us to the words screamed every morning on financial TV. Bull market, bear market. Let's actually define them instead of vibing. A bull market is a 20% rise off recent lows. A bear market is a 20% drop off recent highs. That is it. Here is the data nobody puts on the Chiron. According to First Trust, since 1950, the average bull market has run about 4.5 years, with an average gain of 154%. The average bear market has lasted roughly 9.6 months, with an average loss of 32.5%. Read that twice. Bulls are longer and bigger. Bears are shorter and smaller. The math is on your side if you can survive your own brain. But here is the deeper question. Why do so many people lose money anyway? Loss aversion. Watching a portfolio drop 30% in 6 months feels like getting punched in the chest. Every time you open the app, watching it climb 30% over 18 months feels fine, pleasant, forgettable. The pain is louder than the gain every single time. So the average beginner sells at the bottom, locks in the loss, parks in cash, and tells themselves, I'll get back in when things calm down. They never do. Charles Schwab ran the numbers. Investors who stayed, put through the 2008 crash, and rode the recovery into 2018, averaged about 8% per year. The ones who panicked, sold, and sat in cash earned essentially nothing. Same decade, same market, 2 completely different retirements. The only variable was whether their stomach held. Let's get tactical, because theory without execution is just expensive entertainment. Order types. A market order says, I want in right now at whatever the screen shows me. Fast, certain, but you accept whatever price the market hands you that second. A limit order says, I'll only buy at $50 or less. You get price control. You might also get nothing if the stock never touches your number. Both have a place. Beginners default to market orders out of impatience and bleed pennies on every trade. Pennies add up fast. So drop this in the comments. Which one of these mechanics did your school, your parents, or your first broker completely fail to explain to you? Dividends, buybacks, or loss aversion? And how much do you think that single blind spot has already cost you? You tap buy on 100 shares of a stock, sitting at exactly $100. You blink. By the time the order actually fills, the price has jumped to 102, and you just handed the market $200 you never agreed to spend. That is a market order on a thin moment. Here is the thing nobody warns you about. A limit order at 100 would have simply refused to fill, and refusing to fill is sometimes the smartest move your money can make. On Apple or Microsoft, this barely registers. On some small cap ticker, trading on fumes, that little speed gap can quietly eat a whole paycheck. Now, let's talk about the safety net everyone brags about and almost nobody understands. A stop loss sounds like adult behavior. You buy at 100. You set the floor at 85. You tell yourself, I'm capped at 15% down. I'm protected. Sounds great. Here is what nobody tells you. Stocks don't drop in straight lines. They flinch. Your stock can panic dip to 85 for 20 minutes. On some headline nobody remembers, by Friday, trigger your stop, dump your shares, and then quietly grind back to 110 while you're staring at a realized loss. You didn't manage risk. You got shaken out. This brings us to bid and ask, which sound like trader vocabulary, but are actually attacks. You're paying every single time you click. The bid is the highest price somebody will pay for the stock right this second. The ask is the lowest price somebody will sell it for right this second. The gap between them is the spread, and that gap is where your money goes to die. On Amazon, it is a penny. On some illiquid microcap, it is 50 cents or worse. Picture this. Bid is 10. Ask is 10.20. You buy 100 shares for $1,020. If you turned around 1 second later and sold, you'd get 1,000 flat. You're down $20, and the stock hasn't moved at all. That is the spread, eating you alive. Multiply that by a day trader making 40 trades a day, and you start to understand why most of them quietly lose. Volume is the next piece, and it is simpler than people make it. Volume is just how many shares changed hands today. High volume means there is a real crowd in the room, so you can get in and out without shoving the price around. Low volume means you're trading in an empty parking lot, and your own order can move the tape. There is a tell in this, too. When a stock that normally trades 1 million shares suddenly trades 10 million, something happened. Could be news, could be a rumor, could be a whale unloading. You don't always know what, but you know the room just changed. Now volatility. Volatility is how violently a stock swings. Tech names jump around. Utilities mostly nap. Here is the psychological trap that gets beginners every time. They say, I want to make money fast. So They chase the wildest mover on the screen. 2 days later, it is down 15%, and they're texting friends, asking if they should cut their losses. Volatility cuts both ways, always. You don't get the upside lottery ticket without the downside lottery ticket stapled to the back. Simple. Beta puts a number on that swing. Beta of 1 means the stock breathes with the market. The beta of 1.5 means it breathes harder. Market goes up 10. This thing's expected to go up 15. And yes, the same math runs in reverse on red days. Beta under 1 means it is calmer than the index. Conservative money hunts low beta. Aggressive money hunts high beta. Most beginners think they're conservative until their first 10% down day, and then they find out who they actually are. Now let's get into the part that, honestly, might be the single most important thing a beginner ever learns: index funds and ETFs. An index fund tracks a basket, like the S&P 500, which is just the 500 largest public companies in the United States. Buy one share of an S&P 500 fund, and you instantly own a sliver of all 500 at once. That is not a slogan. That is structural diversification baked in on day one. Here is why that matters in dollars. If you hand-pick 10 stocks and one of them goes to zero, 10% of your portfolio just evaporated. If you own the index and one of those 500 goes to zero, you barely feel it because you still own 499 others quietly doing their job. And listen, this isn't some Reddit theory. Warren Buffett, literally one of the greatest investors who has ever lived, has publicly said most people should just buy a low-cost S&P 500 index fund and hold it forever. In the actual instructions he left for his wife's inheritance, 90% goes into an S&P 500 index fund. 90% from the guy who built his life picking individual companies. Here is the stat that should end the argument. Over the 15-year stretch, ending in 2020, according to the S&P indices versus active scorecard, 89.4% of actively managed large-cap mutual funds underperformed the S&P 500. Read that again. The professionals, the suits, the people whose entire full-time job is picking winners, lost to a boring index almost 9 times out of 10, and they charged you 1% a year, sometimes more, for the privilege of losing. Meanwhile, an index fund clips you a few basis points and goes back to sleep. So ask yourself honestly, whose pocket has your active fee actually been filling? Yours or theirs? Drop your answer in the comments. You think a 1% fee sounds like nothing, right? It is basically a rounding error on your statement, a tiny line item you scroll past without thinking. Here is what nobody tells you. Drop $10,000 into the market. Ride a 7% return for 30 years, and at a 0.1% fee, you walk away with around $72,300. Same exact 10 grand, same exact 7%, same 30 years, but with a 1% fee, you end up at $57,400. That is almost $15,000 vaporized off a single $10,000 deposit. Now picture a $200,000 portfolio running that same leak for a lifetime. We're talking hundreds of thousands of dollars quietly siphoned out while you thought you were barely paying anything. Brutal. Now, Let's talk about the vehicles you're actually using. ETFs are basically mutual funds with a passport. They trade on the exchange like a regular stock, which means you can buy at 9:35 in the morning and sell at 3:55 in the afternoon if you want. Mutual funds, you're stuck with whatever price prints once after the closing bell. That is why most index funds today live inside an ETF wrapper. More flexible, usually cheaper, fewer hidden frictions skimming your gains. This brings us to diversification. And here is the thing, almost everyone gets this wrong. You hear, don't put your eggs in one basket, and you go, cool. I own 10 stocks, I'm diversified. Not even close. 10 tech names is not diversification. It is one bet wearing 10 costumes. The sector tanks. All 10 go down the elevator together. Real diversification is spreading across sectors, industries, geographies, asset classes, the actual machinery of the economy. Tech, healthcare, financials, energy, consumer staples, each one runs on a different cycle. Boom times, tech and consumer discretionary print money. Recession hits, people still buy toothpaste, still pay the electric bill. So staples and utilities hold the line while everything else bleeds. Once you see that, your portfolio stops feeling random. Now bonds. Strip away the jargon, and a bond is just a loan you're making to a company, to a government, to whoever's borrowing. They pay you interest along the way, then hand back your principal at the end. Lower risk than stocks, lower returns too. That is the trade. A balanced portfolio leans on both. If you are 25, you can stomach the volatility. So 90% stocks and 10% bonds is reasonable. If you are 60 and 3 years from retirement, you can't afford a 40% drawdown right before you start drawing income. Maybe you're 50-50. Maybe you're tilted heavier into bonds. The mix has to match the timeline. Here is the deeper question though, and this is where most beginners completely miss the plot. Asset allocation. How you split between stocks, bonds, real estate, and cash matters more than which specific tickers you pick. There is an actual study on this, Brinson, Hood, and Biebauer, and they found that over 90% of a portfolio's return variability comes from allocation, not from stock picking, not from timing the market. 90%. Meanwhile, everyone on Reddit is sweating over the next hot ticker. They're optimizing the 10% and ignoring the 90%. Wild. Now, let's talk about how you actually buy in without losing your mind. Dollar cost averaging. You commit to a fixed amount, say $500, every single month, no matter what the headlines say, no matter what the chart looks like. Markets high, your 500 buys fewer shares. Markets crashing, same 500 buys more shares. On sale, over the years, you smooth out your average price, and you take emotion out of the cockpit. And here is the psychological piece. Nobody wants to admit the hardest moment to invest is when the screen is red, the news is screaming, and your gut is whispering, get out. That is literally the best moment to buy. Dollar cost averaging drags you in anyway, because the transfer hits automatically, regardless of how scared you feel. Discipline beats instinct. This brings us to the engine underneath all of it, compound interest. Einstein supposedly called it the eighth wonder of the world. Maybe he said it, maybe he didn't, doesn't matter. The math is real. You earn returns on your money, then you earn returns on those returns. And the snowball gets bigger every single year. Drop 10 grand at 10%. Year 1, you've got 11,000. Year 2, that 10% is calculated on 11,000. So you pick up 1,100. Now you're at 12,100. Year 3, the 10% is bigger again because the base is bigger. Each cycle, the gain itself is gaining. And here is the example that should genuinely make you uncomfortable if you're putting this off. Person A invests 5,000 a year from 25 to 35. Then completely stops. Total contribution, $50,000. Person B doesn't start until 35. Then grinds 5,000 a year all the way to 65. Total contribution, $150,000, 3 times more cash out of pocket, at 7% returns, both standing at age 65. Person A has roughly 602,000. Person B has about 550,000. The person who invested a third as much money won, because they bought 10 extra years of compounding. Those 10 years did more work than the next 30 combined. That is not a typo. That is how the math actually behaves. So here is my question for you. Drop it in the comments. How old were you when you made your first real investment? And if you could go back, how many years earlier would you start? You sell a stock you've been holding. You see a fat green number on the screen, and you start mentally spending it. New laptop, nice dinner, maybe a little weekend trip. Then April rolls around, and the IRS quietly walks up and takes a chunk you never budgeted for. Here is the thing. The day you sell is not just a profit event. It is a tax event. And the calendar literally decides how badly you get hit. Let me make this stupidly concrete. You buy a stock at $1,000. You sell it at $1,500. That $500 gap is a capital gain. Sell it inside 12 months. That is a short-term capital gain, and the IRS treats it like wages, taxed at your ordinary income rate, which can climb all the way to 37%, depending on your bracket. Hold it past the 1-year line by even a single day, and suddenly it is a long-term gain, taxed at 0, 15, or 20%. Same trade, same profit, wildly different math. Run the numbers, and it gets uncomfortable. $10,000 profit, short-term, 24% bracket. You hand over $2,400 and walk away with $7,600. Same 10 grand. Long-term, 15% rate. You pay $1,500 and pocket $8,500, $900 extra dollars, just because you sat on your hands one more day. That is not strategy. That is a calendar. This is exactly why buy and hold isn't just easier on your nerves. It is mechanically more tax efficient than constant trading. Now, let's talk about rebalancing, because this one quietly saves people from themselves. Say your target mix is 70% stocks, 30% bonds. Stocks rip for a year, and now you're sitting at 80-20 without lifting a finger. Rebalancing means selling some of those winners and buying more bonds to drag you back to 70-30. Feels wrong, looks wrong. Actually, it is the textbook move. You are literally selling high and buying low on autopilot. Exactly what every investor swears they'll do, and almost nobody does. This brings us to the numbers people obsess over. The 52-week high and low. They're exactly what they sound like. The top and bottom prices a stock printed in the past year. Near the low, your brain whispers bargain. Near the high, it whispers bubble. Both whispers can be wrong. A stock at the lows might be cheap, or the business might be quietly rotting. A stock at the highs might be overpriced, or the company might be running so hot it is earning every dollar of that price. These numbers are context. They're not signals. Then you get into support and resistance, which lives in technical analysis land. Support is the price floor where buyers tend to wake up. Resistance is the ceiling where sellers tend to dump. Stock bounces off $50 4 times in a row. Congratulations. 50 is support. Keeps getting slapped down at 70. 70 is resistance. Some traders treat these levels like gospel. Others think it is astrology with charts. Honest answer: it works partly because enough people believe it works, and they trade off the same lines. So the prophecy fulfills itself. Here is where the bigger fork shows up. Fundamental analysis means studying the actual business, revenue growth, margins, moat, management, where the industry is heading. The question is simple: is this a real business worth owning a slice of? Technical analysis flips the table. It ignores the business entirely and reads the chart, the volume, the momentum, hunting patterns to guess tomorrow's price. Day traders live there. Long-term investors mostly don't. My take: if you're a beginner trying to build wealth across the next 2 or 3 decades, fundamentals win every time. Predicting what a candlestick means by Friday is a coin flip dressed up as expertise. Now, here is the deeper question. What about betting against a stock? That is short selling. You borrow shares, sell them right away, hope the price tanks, buy them back cheaper, return them, keep the spread, borrow 100 shares at 50, sell for 5,000. Stock drops to 30, buy back for 3,000. Walk with 2 grand, clean. In theory, here is what nobody tells you. If you're wrong, your losses are not capped. The stock rips to 100. You have to spend 10 grand to close a 5 grand position. You're down 5,000 and counting. Up has no ceiling. Beginners shorting stocks just don't. Margin is the same trap with a friendlier face. Your broker fronts you money so you can buy more than your cash allows. 10,000 of your own, 50% margin. Now you're swinging 20 grand worth of stock. Goes up 20%. You make 4,000 instead of 2. Feels like a cheat code. Goes down 20%. You lose 4,000 instead of 2, and you still owe interest on the loan that helped you lose it. Margin doesn't change your edge. It just multiplies whatever's already happening, including the disasters. This is how people blow up entire accounts in a single bad week. And finally, IPO, initial public offering. The moment a private company opens its doors and sells stock to regular investors for the first time, usually to raise capital and let early backers cash out at scale. So here is the question I want you to drop in the comments. Which one of these almost wrecked you? The tax surprise, the margin trap, or the short that went the wrong way? Tell me the dollar amount. I read every reply. You think buying into a company's IPO means you're getting in on the ground floor. That is the pitch, right? Early access, big upside, the next Amazon. Here is what nobody tells you. A University of Florida study tracked IPOs over 5-year windows and found they underperformed the broader market by roughly 3% per year. Every year, for 5 years. The Amazons and Googles get the headlines, but they're outliers. The median IPO is a mediocre bet dressed up as a once-in-a-lifetime opportunity. The whole event exists to give early investors and employees an exit. You're the exit. Now, let's talk about the magic tricks companies pull on their share count. A stock split sounds exciting until you do the math. 2 for 1 means you owned 100 shares at $100. Now you own 200 shares at $50. Same $10,000. Nothing changed except the sticker. Companies used to do this so retail investors could afford a single share. But with fractional shares everywhere now, it is mostly theater. Reverse splits are the dark version. 1 for 10 means your 100 shares become 10 shares at 10 times the price. Why would a company do that? Usually because their stock is so beaten down, they're about to get kicked off a major exchange. Reverse splits are a flare gun. The company is in trouble. Here is the thing about actually owning a piece of a business. If you've never opened the 10K, you don't own a stock. You own a ticker. The 10K is the annual report, the full inventory of how the business actually makes money, what could blow it up, and where the cash goes. The 10Q is the lighter quarterly version. Earnings calls are where executives sit across from analysts and explain themselves. All of it is free. All of it is public. Most people skip it and then wonder why their portfolio surprises them. This brings us to insider trading, which is more nuanced than people think. If a CEO knows next week's earnings are a disaster and dumps shares before the news hits, that is illegal, full stop. But insiders are allowed to buy and sell their own stock legally, as long as they file the disclosures. That paper trail is gold. When a wave of executives are buying with their own money, they usually believe in something. When they're all quietly selling into strength, pay attention. Proxy voting is the part of ownership almost nobody uses. As a shareholder, you get a say on board members and executive pay packages. Small investors throw the envelope away. Activist investors stack up shares specifically to weaponize those votes. And force change. Same, right, very different energy. Then there is the wash sale rule, which catches people every tax season. Sell a stock at a loss. Buy that same stock or anything substantially identical within 30 days on either side. And the IRS disallows the loss. You don't get the deduction. The rule exists to stop people from booking fake losses while never actually leaving the position. Mark your calendar or lose the write-off. Now, the labels. Blue chips are the old reliables. Coca-Cola, Johnson & Johnson. Procter & Gamble, big, boring, durable. Penny stocks are the opposite universe. Anything trading under $5, usually in tiny companies you've never heard of. Beginners fall for the math fantasy. A dollar stock only has to hit $2 and I've doubled. Sure, most penny stocks don't double. Most go to zero. They're thinly traded, easy to manipulate, and built on hype. Growth stocks are the companies plowing every dollar back into expansion. No dividend. All chips on getting bigger faster. A lot of tech lives here. Value stocks are the supposedly underpriced names in mature industries, often paying dividends, where the bet is that the market eventually wakes up. Cyclical stocks ride the economy like a wave. Airlines, hotels, construction, hot in booms and ugly in recessions. Defensive stocks are the steady ones, utilities, toothpaste, the stuff people buy whether the economy is on fire or in a ditch. And here is the deeper question almost nobody asks before clicking buy on a fund. What is the expense ratio? That is the annual fee, expressed as a percent. 0.5% sounds harmless. $5 a year per thousand invested. Index funds often run under 0.1%. Active funds love 1% or more. Run that across 30 years of compounding, and that quiet little fee can quietly eat a six-figure chunk of your retirement. The fee is small, the damage isn't. So tell me, which one of these tricks, the IPO trap, the reverse split flare, or the expense ratio leak, has been quietly costing you money without you realizing it? Drop your answer in the comments. I'm reading everyone. You think you're going to outsmart the market by buying low and selling high on instinct. Here is what nobody tells you. Fidelity ran the numbers and discovered something almost embarrassing. The investors with the best returns weren't geniuses, weren't day traders, weren't people glued to CNBC. They were people who literally forgot. They had an account, forgot, and the runners up. Dead people, accounts that just sat there, untouched, compounding in silence, while the living were busy. Panic, selling at the bottom. Let that land for a second. Now, let's talk about what the indexes you keep hearing on the news actually are, because most people nod along without a clue. The S&P 500 tracks the 500 biggest U.S. companies, weighted by market cap, meaning the giants pull the strings. When an anchor says the market was up today, 9 times out of 10, that is what they mean. The Dow only watches 30 names and weights them by share price, which is honestly a relic. The Nasdaq Composite leans tech-heavy and packs in over 3,000 stocks. Useful to know, not useful to obsess over. Here is the thing. None of this trivia builds you a single dollar unless you actually move. So here is the playbook, plain and stripped down. Step 1. Open a brokerage account this week. Fidelity, Vanguard, Schwab, all solid, all charging 0 commission on stock trades. Step 2. Start with index funds, a total stock market fund, or an S&P 500 fund. Hands you hundreds, sometimes thousands, of companies in one click, with fees so low, they're almost a rounding error. And over time, you'll quietly beat most of the suit and tie pros on Wall Street. Step 3. Automate it. Set a recurring transfer from checking into your brokerage every single month. That one move kills emotion and installs a habit. Step 4. Raise the dose. Start at 100 a month. Get a raise. Push it to 150. Bonus hits. Push it again. Step 5. Mute the noise. Financial media eats your attention for breakfast. They scream crash, scream hot stock, scream rotation, because fear and FOMO sell ads. Check your portfolio once a quarter, not once a coffee break. Step 6. Keep learning. You already know more terms than 90% of the people around you. But business, tax strategy, psychology, there is always another layer. But here is the deeper question. Are you actually going to do this? Because the stock market is genuinely one of the most reliable wealth machines a regular person has access to, and it only works if you press the button. You can watch this, feel fired up, close the tab, and change nothing. Or you can open the account this week, drop your first $100 in, and finally start playing the game. The vocabulary means nothing. If you never trade, the math means nothing while your savings sit in a checking account, earning 0.01%. As inflation quietly chews through it, here is the hard truth. Nobody likes to say out loud. Every single person who built real wealth through investing started exactly where you're sitting right now. Confused, unsure, half convinced they'd mess it up. The only difference, they started anyway. They bought that first share without understanding everything they held through crashes that felt like the world was ending. And 20 years later, they're free, while the friends who waited for the perfect moment are still waiting, still researching, still about to start next month. You already know what a stock is. You know how markets work. You know why index funds win. You know fees matter. You know time is the cheat code. The only thing left to decide is whether this becomes action or just one more interesting video your financial life never felt. So tell me in the comments, are you opening that brokerage account this week? Or are you giving me the excuse you've been telling yourself for the last 3 years? I'm reading every reply.